everybody. Hope you are well. We have the spring edition of the Wealth Perspectives here. Lots to talk about as we've had a ton of headlines to start the year here. So I thought I'd dive in. As always, there'll be a link to this below. So any of these articles of interest to you, definitely click on that link and read further, but I'll just kind of go through quickly here. So navigating change, first article, speaking about basically the change in the world, looking back to the tariffs that were announced last year, and really the global switch to more trade partnerships outside of the U.S., more of agreement between Europe, Asia, countries like Canada and Australia to work with each other and not have such a reliance on the U.S. We'll see if that shift continues here with that uncertainty around U.S. trade partnerships. Really a case for diversification and making sure that your portfolio isn't too concentrated in one geography or one sector. Speaking of tax season, it is March 31st, the deadline to get slips out to investors, end of April to file your taxes. So just make sure that if you're going to file early, that you do have all the slips and that nothing is coming after you file. Always best to kind of wait till April if possible, unless you're absolutely sure you have everything. The blue box here, speaking of CRA rooms, just a reminder that they're not always incredibly accurate on the numbers, especially the TFSAs. They won't have the reports from 2025 or anything you've done in 2026. So keep that in mind. Those numbers may not be accurate until later in the spring. Looking at a bit of a rotation, we spoke a little bit about this in the first article, but looking more in depth, we've seen those growth names up until the beginning of 2025. Those big seven, the big tech names dominating U.S. markets, dominating the global returns. That's been a switch over the last 12 to 18 months. Canadian markets, European, Asian markets outperforming, and especially some of those more defensive sectors. Banks have been doing well. Utilities, the commodities, obviously with gold rising, a lot of those names outperforming those tech names, and some of those tech names, those big seven, actually negative through the start of the year here. So keep that in mind. Again, case for diversification, not just between sectors, but between different geographies, different countries as well, and different asset classes. So again, looking at things like real estate, infrastructure, and some alternatives to mix in there and really hedge the returns and smooth out your investment life. Speaking of the US dollar has been weak. Maybe not a surprise with the uncertainty that's surrounded it. The economy uncertain with the tariffs, what exactly the longer term effect of those are going to be. But US dollar was down 9.5% against a basket of major currencies in 2025. Also weaker to start this year. Obviously, the news of war in Iran not helping the certainty around the US dollar and the US economy. So weaker there. Not to say it won't rise back up, but again, a case for diversification, not being fully invested or heavily invested in US dollar stocks, ways to hedge around that if you need to. Housing prices, always a hot topic. Of course, the housing market, especially in the major markets, Canada, Vancouver, and Toronto, up until 2022 or so, going up 20, 30% a year. Everybody thought that would never stop. Of course, we've seen some weakness, not a bubble bursting by any means, but down 10, 15, 20% or so over the last couple of years in those major markets, especially. It's just a reminder that the housing market is not immune to corrections. There can be some softness, weakness there. And of course, the illiquidity kind of hides some of that, but also makes it hard to move in and out of real estate. So keep that in mind. Again, I'm not making a call, but obviously interest rates have come down, which should help on the demand side. But of course, you've got lots of other potential issues out there. So many calling for further softening in the housing market. Time will tell. And last but not least, article on volatility. We have seen a lot of volatility recently with news of this war. of course, in the markets, and every headline moving the markets up or down, even intraday, a couple of percent. But keep in mind that that is part of the markets, and without that volatility, that negativity, you don't get the positivity, and that's kind of the price you pay for outsized returns, as they say, is having to sit through that volatility. But in the long term, you can see there amid the first kind of box here where your investments will be in 20, 30, and 40 years with the $10,000 contribution at just a 5% growth rate. So the power of compounding, and you can see the headline here, building substantial wealth takes time. So starting early, continually adding, not trying to time the markets, but making sure that your portfolios are well diversified, quality investments, and set up to match the risk level you need for your various objectives through life. Having that plan is most important, and having that plan is what allows you to stay invested and to continue to add when things get tough, because as we've seen, and we've been through numerous ups and downs in the markets, but the toughest time to invest is the best time to invest. And when things are looking terrible across the globe and in the global economies, that's often the best time to put money into your investments. So if you have a plan, you're doing it regularly, that takes care of that emotional side. So anyway, further, if you want to look into these articles, you can take a look at that link below. Otherwise, we will be back with our regular videos soon, and of course the next quarterly in the summer, quarterly wealth perspective. So I hope you enjoy it. Any questions, let me know. Of course, always available to chat or book a meeting. Thanks. Take care.